Good morning. My name is Sophie Boehlen. I am a realtor with Keller Williams and also a longtime investor in the Cleveland market. I am here today with a lender we work with very closely. Why don't you tell us your name?
It's a question I get, Sophie, 1,000 times a day, I suppose, right? Okay. My name is Khash Saghafi. I'm with Liberty Home Mortgage. And of course, what always throws people for a loop is the spelling of it. So it's spelled Khash. It's pronounced phonetically Hesh. So it's Hesh. The K is silent. The A is like an E. I'm a first generation American. My parents are from Tehran, which is the capital of Iran in the Middle East. And I was named after a king, King Xerxes of Persia, King Heshar. So that's me. I didn't get any of his money, unfortunately, but I got his name.
Yeah.
So yeah, it's pretty interesting. It's a lot longer than that too, by the way. And my own mom says I have trouble pronouncing it, but I say Hesh.
Hesh. All right. So everybody, his name is Hesh. Remember that.
That's where we go. We'll try to memorize it.
All right, so today we are doing a series on loans for first-time home buyers, but also for buyers who are, maybe have not bought a home in quite a few years and kind of forgot the process. So I do get a lot of questions. I'm sure you do too, and maybe we can answer a lot of those and clarify the process.
I'll do the best I
for
can.
the public out there. So let's get started with facts and myths regarding down payments. So do you really need 20% to buy a house?
That is a great question. You absolutely, positively do not need 20% to put down on a house at all. You can go with, there's down payment assistance programs in which you can get a grant or a gift for the down payment. Down payments as low as on conventional loans, you can go as low as a 3% down. Fannie Mae, Freddie Mac, they have a home program called the Home Ready. First-time home buyer program, 3% down. Even a non-first-time home buyer can go 3% to 5% down. FHA comes in at 3.5. So you do not need the traditional 20% down. Just a little worthless fact for you. Back in the 1930s when FHA, for example, first came out in 1934, the minimum down payment was 50%.
Wow.
So that's where they actually started at. But it's since gotten a lot less than that, thank goodness.
Yes, exactly. My goodness. All right, so where can down payment funds come from?
It's a great question again. I mean, so down payment funds, for the most part, the two biggest things I tell people is family is fine, or your checking, savings, 401ks, retirement accounts, and family. Now, in certain cases, you can get one from your employer. Doesn't happen too often. But it has to be money saved over a 60-day period, over a 2-month period. It cannot come from credit cards, cash advances, people you're not related to, just strangers. Sellers cannot contribute towards the down payment. That's a big no-no.
That was my next question.
Yes. So sellers cannot contribute. And a big thing that drives people, probably, Sophie, the absolute craziest is the depth of verifying the funds to close. So the length that we go to as an industry, the mortgage banking industry, to verify where the money came from, it drives people crazy. So it has to be verified. You want to follow the advice of the loan officer who's directing you, but it's pretty intense.
So if I were the type of person who saved a big chunk of my pay in a box at home, I would not be able to use those funds?
It's absolutely correct, because the problem with that method, which is, so you saved up money or you withdrew money from your bank account and you put it in a shoebox at home and you've got cash. Mm-hmm. The problem is you cannot prove where cash came from. A lot of the rules and guidelines we follow today were born from the mortgage crisis back in 2007, 8, 9, 10. So from that experience, what they found was a lot of sellers, it used to be before that time, I would say to a buyer, you need $3,000 to come to the table and just get a cashier's check at the bank. It doesn't really matter where it came from. So what they discovered was a lot of sellers were giving money back to the buyers to put down, which meant the buyer really had no vested interest. They didn't really come up with anything. So in a very roundabout way, the buyer was coming to the table with nothing. Of course, the mortgage crisis happened. They overhauled all of our rules and guidelines. So now we have to verify where that money comes from. In cash, you cannot prove the source of it. I've had people say, "Hash, but it's my work, it's my job, it's my friend." You can't really prove that. So money in a shoebox at home is not acceptable. Be real careful with depositing cash into your bank account.
Got it. Thank you. All right, next topic, understanding credit scores. So where, first of all, can I get a copy of my credit score for free?
So the free version of your credit score, every consumer in the United States is entitled to one copy of their credit report for free once a year. That website is www.annualcreditreport.com. Now, that'll give you copies of your credit report. It will not give you scores. So what you'll see with scores, because everybody gets so hung up on what's my score, what's my score, what's my score, is to get a score, you will not get an annual credit report. You have to pay to get a score. Now, if you want to get a score, you can go directly to the credit bureaus, Equifax.com, Experian.com, or TransUnion.com. If you pay money, they will give you a score. The problem with that is the score they provide you with will not be the same score that a mortgage lender gets. The absolute worst analogy, Sophie, and I think you know this already about me, is I always try to give analogies to things, yes, right? And they're probably wrestling analogies more than anything, but this is not a wrestling one. So the analogy I always give to everybody, and a lot of people use Credit Karma, they use Score Watch, Discover Credit Card, they'll say hash Capital One, my bank gives it to me, I went directly to TransUnion. The problem with all of those places for a credit score is none of them use the same formula as each other, or that the mortgage lending, the mortgage banking industry uses to generate a score. And the worst analogy I always give people is imagine going to Little Caesars, Domino's, and Pizza Hut to buy a pizza and ordering a pepperoni pizza. Everybody knows they would all taste different. But if I were to say, how does it taste different? It's the same thing. They would all say, well, they have different ingredients. Credit scores are the same thing. They all have different ingredients that go into the formula. So the truth is, if you go to Credit Karma, the formula they use to determine that number is different than what is used by my industry. I think it's the most misleading, worst thing on the planet, but unfortunately I don't make the rules. So that's in regards to the score and how the score works.
And usually a lender score is slightly lower than what we find from our credit card company.
9 times out of 10, the lender score, Sophie, exactly as you said, will be lower than what a consumer gets online. Mm-hmm. I have my personal theories and beliefs and opinions. I personally think if Credit Karma showed you that your credit score was 490, I don't think you'd be going there anymore to look at the score. So it's not in their best interest to get eyeballs on their site to show you low scores. So it's going to show you higher scores. Predominantly, those are, on that website specifically, come in higher than most consumers are when we pull them. But to be fair about it, it's not exact. I've seen it the reverse also, but you are correct. Mm-hmm. Where they get their score from, 9 times out of 10, it's going to be higher on those sites than when we pull it in the lending industry.
And what is the difference between a FICO score and a credit score?
The difference between the FICO score and the credit score, there's not really a difference between the two. I guess they're interchangeable. The FICO model was invented by the Fair Isaac Corporation in the 1950s. They call it the FICO model. It generates a score. So I suppose overall it's sort of the same.
It's the same. Got it. So how does my score affect the terms of a loan?
That's an incredible, holy smokes, that's a really good question. So how does your score affect the terms of a loan? For example, mortgage loans are heavily driven by the score, by that number, because the score, what a credit score actually indicates, it indicates the chances that within the next 24 months you are going to go late on your bills. Naturally, the higher the score, the less likely you are to go late. The lower the score, the higher likelihood of being late. As the likelihood of being delinquent goes up, that increases the risk of the loan. So when the risk of the loan goes up, the interest rate travels with it. So the lower your score, the higher your rate. Now, to be fair about it, even with a super, super low score today, you're in the 4s or 5s maybe. I mean, there's some loans out there that they're called non-QM loans, non-qualified mortgage. They're I think honestly they're subprime loans, but we don't call them subprime because the whole world would panic, like, oh my goodness, these people are doing this again to us. But non-QMs, those interest rates go up into the 6s and 7s. Now the truth is, I don't think necessarily 6s and 7s is bad when people have, my first mortgage I took out back in the late 1990s was at 7.5, and I used to brag about that interest rate to people.
Right.
So,
I remember. So
yeah.
it was mine.
Yeah. So
So yes, it's not so bad. So what can a person do if their credit score is too low to qualify for a mortgage today?
So that's a great question. So ultimately, what can you do if your credit score is too low to qualify for a loan? So the first thing you want to do, and I always tell people this, Sophie, is you've got to get your hands on your credit. You cannot fix something that you do not see. So you have to get copies of all 3 credit reports. Now, whether you go to annualcreditreport.com to get copies of all 3, Credit Karma, for example, and I keep bringing that one up, that's just a big name that people know. That gives you 2 of the 3 credit bureaus. I always recommend the 3 credit bureaus themselves, which is www.equifax.com, transunion.com, or Experian.com. I personally like myfico.com. That's the website of the Fair Isaac Corporation. They invented the model, and that's the model we use. So my goodness, I like going to the source of it, I suppose. But step 1, get copies of all 3 bureaus. That's the first thing you do. The second thing you do is you pay off any negative items on your credit. So if you have collections or derogatories or something like that, you want to pay those off. Step 3 is paying off credit cards. High credit card balances relative to limits adversely affects the score. Pay off your credit cards. The third thing, and this is where it turns into a slow play, kind of a long game, is you've got to pay all of your bills on time for an extended period of time. Extended period of time is 1 to 2 to 3 years. So those are the steps to repairing your credit score. The problem is patience is a virtue, and it takes a little bit of time. I just saw a customer drop 83 points from one 30-day late payment on a credit card. That just happened 2 weeks ago.
Wow.
83-point drop. We pre-approved her some months back. She came back to buy. We had to repull the credit. In the mortgage world, credit expires after 120 days. So credit is good for 120 days. We were outside of the window. We repulled credit. Since then, she went 30 days late on one single bill, dropped her 83 points. It's kind of unfair that one late drops you that dramatic of a change. It just is. It's unfortunate, but it is. You got to watch those lates.
So are credit repair agencies worth it?
That's a great question. Man, you got a lot of, these are pretty impressive questions, actually. They really are. Are credit repair agencies worth it? The truth of the matter is anything you do to fix your credit, anything, just monitoring it, just being aware of it is good. So I'm never going to say credit repair agencies are bad. What you have to be careful with is there's different levels of credit repair agencies out there. There just are. It's just tough. I mean, it's hard. I know some people that own some credit repair agencies. They are great people. I think also there's a level of expectation. I think people expect that if I pay this credit repair company over the next 30 to 60 days, my credit magically is going to go up 100 points in a month. It takes a long time. It's like, again, here I go with analogies. It's like hiring a personal fitness trainer. You hire a personal fitness trainer, you've been living the wrong lifestyle for 30 years, and you hire a personal trainer, it's going to take them 1 or 2 or 3 years to get you into shape. So credit repair is the same. I think if you have the right expectations that this is going to take time and money and patience, I think most credit repair agencies are probably good places. I personally tell people that the only person, in my opinion, that could do it right is you. And you've got to, when you're vested and you're interested, you will attack it and you will go after it. 30 minutes a week, once a week on Sundays, make a commitment to that and do it every week is what I tell people. I could talk for hours on this stuff, but of course I appreciate the opportunities.
Yes.
That's beautiful. So pay attention to it.
And what about the credit boost that you see advertised on TV? Does that make any change?
The credit boost that is being advertised on television right now, so these are like your rent, they can put it on your credit report, which could boost your credit. I haven't seen that just yet directly on anyone's credit that I've pulled where they've done it and it worked. So I'm not going to necessarily pass judgment right now on it. It's something that I think if you research and if people look into and educate themselves on, it's something that could possibly be used to their benefit. I would absolutely look into it. Anything, especially when your score is lower, that you can do that can possibly move that score up, you definitely want to do and give it a try. But you got to research and educate yourself, such as watching what you're doing right now with these videos of getting the information out there.
Well, thank you. So is a person's credit score the only thing that you look at to qualify someone for a mortgage?
Absolutely not. I wish it was, because if it was, I'd be done by 10 in the morning every single day. The score is it's one ingredient out of a lot of ingredients to determine whether or not you get the mortgage loan. It's a big piece to the puzzle, but absolutely not the only piece to the puzzle. What I always tell people is that I say credit is 1/3 of getting a loan. It takes credit, income, and money. So credit determines if you can even get a loan. Income determines how big of a loan you can get, and it takes a little bit of money for a down payment, the inspection, the appraisal, earnest money, certain things like that. You could easily be sitting on a 700 credit score, but if you had a bankruptcy one day ago, Chapter 7, you're not getting a loan anywhere. Doesn't matter how much money down, doesn't matter where you work, what your income is, what your score is. So the score is not the only piece to the puzzle. It's a big piece, and it's good when people say I have a 650 or a 690. It's not the only piece. It's far from it. There's a lot that goes into it.
So let me give you an example. Let's pretend I am a young professional. I decided to live at home to save some money. I do not have student loans. I do not have a car loan. And I have a checking account, a savings account, and I decided to stay away from debt, so I did not open any credit card. What are the chances that I get approved for a loan with that kind of just income and a checking and a savings account?
But no student loans on credit, no car payment, no nothing like that.
And no credit cards.
Okay, so again, great question. So you're younger, especially when you're younger. I didn't get my first credit card, I think, until I was graduating college. So I was 22, just about to turn 23 when I got my first credit card. It was Citibank with a $700 limit. And that was my first credit card I ever got. And I was like, oh my God. It was kind of crazy. I felt like I won the lottery or something. I was walking around campus I got this credit. I can go buy anything I want to buy right now. So when you're younger, you don't have the credit developed. You can, typically with FHA loans, VA loans, even USDA loans, they allow you to do what's called non-traditional credit. So traditional credit is credit that reports to the Bureau. For example, your auto loan, your student loans, credit cards, those all report to the credit bureau. Most of them do. When you get outside of that, you get into what's called non-traditional credit, things that do not report. Your gas, your electric, your cable, your cell phone bill, your auto insurance, the rent that you pay to the landlord. All of that is non-traditional credit. So if you have all of the other boxes checked, but you have no credit at all, it's possible to get a loan which allows non-traditional credit. That's what that's called. And you want to talk to different lenders. Most lenders do not give loans with non-traditional credit, but there's definitely some that do. So it's there to do, and it's something to look into for sure.
So definitely not a hard no.
It's not a hard no at all.
Okay.
It's, the other problem we run into, just to be completely honest with it, is typically like you talk to somebody who's younger and they don't have the credit established, but they're living at home with their parents. So suddenly, as soon as they're living at home with their parents, you just took away rent checks, gas, cable, electric, because gas, cable, electric are in mom and dad's name.
Right.
So then they don't have anything. Unfortunately, then it becomes a hard no. You could look at mom and dad co-signing, a family member to co-sign, then you're using mom and dad's credit to help you. So there's still some opportunities. It's definitely not a hard no, though.
Okay, thank you. So I have heard, and this is the last question on credit, I have heard that some people with low credit will qualify and somebody with a higher credit will not qualify. So why is that?
This is where it gets interesting, okay? It gets really interesting. I can give you the black and whites of getting a loan. For example, if you wanted to go for a conventional loan, you could not have been discharged from a Chapter 7 bankruptcy within the last 4 years. That's a black and white, okay? That's an income ratio. Conventional caps you at 49.99% for a conventional loan. Now, I'm not explaining what 49% means, but just take it for what it is. Those are black and whites. Those are hard lines that nobody's going beyond those lines. The problem is in getting a loan, there's something called an algorithm. There's a computer program. Actually, I should say there's a computer program, Sophie. A computer program was invented in 1994. And when you think about the year, that's kind of when the World Wide Web is coming out, all this internet technology, stuff like that, computers. Well, Fannie Mae invented a program which analyzes everything. It analyzes how much money you have. It analyzes what your income is. It calculates the debt ratio. It reads the credit to see how many delinquencies have you had. It's actually a pretty impressive program. Well, that program runs an algorithm. The algorithm is just a fancy formula or a fancy way to say it's a formula to determine risk. So naturally, the question becomes, just talking out loud, like, in your opinion, who's higher risk? If I told you, Sophie, I have somebody with perfect credit, but they're going no money down and they have a super, super high debt ratio. They've never paid rent in their life, and I'm about to drop a $2,000 house payment on top of them per month. High risk, right?
Yes.
Okay, what if I said somebody has a 550 credit score, they have all medical collections, which absolutely hammered their score. They've got a 550, that's a low score. But they're putting 50% down, they have no other debt, and they were paying rent of $2,000 a month, and the new house payment is $1,700 a month. How's the risk of that person?
Or much lower.
Much lower. So the credit score, it would fool you into thinking, well, 550 is bad, 800 is good. But there's other factors in there. So it goes back to the score. But as the score goes down, truly you better have a bigger down payment. That's really what sets the lower scores apart. So people with lower scores, from a lending perspective with the computer program, desktop underwriter, things like that, you better have a bigger down payment, more towards 10 to 20 to 30%, and it goes from there, depending on how low we're talking. If you're talking about 610, 620, 630, you're probably not going to need as big as 30, 40, 50%. But when you go into the 500s, you better be coming up with a pretty big down payment. So as the score goes down, the money goes up.
Okay. Thank you.
Risk reward, absolutely.
Yes. All right. So let's discuss mortgage types. You kind of mentioned conventional, FHA, VA, USDA. What's the difference?
So what I always tell people is there's generally 5 types of mortgages in the United States. And people watching at home, you can even write these down. They're pretty easy. Number 1 is a VA loan. So a VA loan is a mortgage which is guaranteed or backed by the Department of Veterans Affairs. Of course, the downside to a VA loan is that you had to have been in the military and served and have eligibility. So that's a VA loan. So that's one type of loan. A second loan is a USDA loan, the U.S. Department of Agriculture. Now, every time I say that to people, Sophie, the first thing they think is, "Hush, I'm not buying a farm." That's good because I can't do a USDA residential mortgage loan on a farm. But that loan is guaranteed and insured by the U.S. Department of Agriculture. USDA loans, they took the USDA, and in rural areas, you have to be in a rural area to get the USDA loan. The U.S. Department of Agriculture already has a footprint in those areas. So they carved out a little part of the USDA and allowed them to insure or guarantee residential loans. So there's a lot of lenders out there that do loans in rural areas. USDA serves those. That's a USDA loan. Those are no money down, by the way. VA is 0 down. USDA is 0 down. Pretty impressive. Pretty good.
Yes.
Then you go to FHA. That's the third type of loan. FHA is a mortgage loan insured by the Federal Housing Administration. So it's a government agency that insures mortgages. Conventional, the truth about conventional is a conventional loan is any mortgage not insured or guaranteed by the United States government. That's all it is. So, VA is the VA, USDA is the USDA, FHA is the FHA. Conventional is just not one of those. So conventional loan is not insured or guaranteed by the government. And that's a conventional loan. Now, people have heard the names Fannie Mae, Freddie Mac, and I use them all the time. Fannie Mae, Freddie Mac are investors for conventional loans. Well, that's 4 types of loans. The 5th loan I tell people is a portfolio loan. A portfolio loan is a loan in which the lenders, such as ourselves, we don't sell it to anybody. We just give the loan and we hold it ourselves. Now, mortgage bankers or brokers such as myself really don't have portfolio loans. Banks do. A lot of times your local community bank will have products that to someone like me sounds like crazy or off the wall. Well, the truth is that's their portfolio product. So the 5 types of loans are VA, USDA, FHA, conventional, and portfolio. Portfolio is where the bank holds it. They're not selling it off, and they give those loans. Those are typically very high standards, though, for them to give those types of loans.
Okay. So is it true that FHA borrowers are not as strong as conventional borrowers?
I love the question. I just keep saying that in every single question. I probably should just not say it so much, but it's an awesome question. The perception in the public is FHA borrowers are weaker than conventional borrowers. I can show, if I actually had to think about it right now, the last one I did was probably 3 months ago. Conventional, it's not like that at all. I have doctors with 800 credit scores going FHA. I have borrowers with 690s going conventional. Conventional, believe it or not, you could be in foreclosure on your current home and still get a conventional loan. FHA won't touch you for 3 years after the foreclosure. So there is certain aspects of the guidelines where FHA is way more restrictive than conventional. And to qualify in FHA truly makes you stronger even. So it's not like that at all. FHA is more flexible on credit than Fannie Mae is. They're just more flexible. They're more flexible on debt to income ratio. They're more flexible in certain parts of gift money and things like that. But just on the surface, a lot of people perceive it to be FHA is worse, but it's not at all.
And can a borrower qualify for both FHA and conventional?
1,000%. A borrower can absolutely qualify for FHA or conventional, either or they're interchangeable. Absolutely, yes.
Great. Thank you.
Thanks for the question again.
All right. So now, for those buyers who are preparing to buy their first house, what kind of paperwork do they need to provide a lender?
So the paperwork today, of course, it's quite a bit. It's a little daunting for people, even if it's their fifth house. But the general generic level to begin with is 2 recent pay stubs dated within the last 30 days, your last 2 years of W-2s, your last 2 years of tax returns, your 2 most recent bank statements, and a copy of your driver's license and social security card. That's always the beginning point of where we begin. And if you want to do a thorough pre-approval and get pre-approved correctly, you want to turn all of that information in, because when you don't provide all of the paperwork, sometimes surprises happen. And that's where life kicks in. You know, some people pay child support. Child support is shown typically on pay stubs. If the customer doesn't turn over their pay stubs, then the loan officer or lender might never have seen it. They may not have asked the question about it. It may not have been disclosed. So you want to turn over all of that paperwork, and that's your beginning paperwork. Then you start getting into bankruptcy papers, divorce papers, separation agreements, judgments, back income taxes, things like that. So you start digging deeper with paperwork. And it turns into quite a bit of paperwork, but you're applying for the biggest loan of your life and the biggest investment most people ever take part in. So I mean, it's a lot of paperwork, but it's definitely worth it.
And so when you were talking about the latest 2 bank statements, is it just for my checking account or for every single account that I have?
See, I always forget that one, so thanks for reminding of that one. I always say I want your last 2 months of bank statements from all bank accounts. It's always best to give too much information than not enough in my industry, because we run a lot of, my industry runs a lot of programs. There's a program called like a Fraud Guard or a CoreLogic. That's run typically in the middle or at the end of the transaction. Credit is monitored during the whole transaction. There's something called undisclosed debt notifications. So we're monitoring your credit such that if somebody else pulls it, a late payment hits it, or your credit card balances go up, it dings us. So we become aware of this stuff. I've had my Fraud Guard pull up properties in other countries on people where I've had to have them explain that, hey, do you have a loan against this house at this address here in this country? Which I just always remember that one that it got me on. I don't see that a lot because most people don't own real estate in other countries, but some people do. So when do you want me to find something out, sooner or later? The problem with later is it's 2 days before closing. You're getting ready to move. The agents are getting everything organized to finish out. And all of a sudden something comes up. And the big question we get asked is, why are we finding out about this now? If we don't get told it and we have to find it through the programs we run, that's when bad things happen. So you want to give it too much information is always better. So it's last 2 months of bank statements on all bank accounts. And you want to open up with all of that.
So is it true that paying off credit cards in full each month hurt your chances of qualifying for a mortgage?
It's a great question. It's kind of funny because I do mortgages and I sell debt, I suppose, to an extent, right? I bury people in loans for the rest of their lives.
Just 30 years.
That's right. Only 30 years, right? And then if they refinance after 9, then they go back to 30 again. I'm joking. Yeah. I always push for the shorter term loan. Let's shorten the term as we go. So ultimately, what was the question? I just lost my concentration. That's okay.
I said, is it true that paying off credit card bills in full each month will hurt my chances?
Absolutely. So I'm debt averse. So I think you should pay off your credit cards every single month. If you pay your bill, if you pay your bills on time every single month, pay off your credit cards. Just pay them off. You want them active. Active is what is measured by the credit bureau. Carrying balances, I've heard people say, well, Hesh, but if I carry a small balance, it's good. I just pay them off. Pay your bills on time, pay them off, manage the debt. Don't borrow things you can't pay back, and monitor and follow it. And this is what you want to do.
Thank you. Because I know I have gotten a lot of different answers over the years on that.
Yeah, and who knows if I've given different. I just pay them off.
Yeah.
Honestly, I've always said to people, I'm consistent with just pay them off.
Mm-hmm.
If you pay your bills on time, you manage your credit card debt. Here's the truth: you're going to have really good credit.
Mm-hmm.
That's just a fact.
Right.
When you have late payments and things like that, that's when you fall into problems and traps. And carrying credit card balances overall is just not good.
Mm-hmm. Expensive.
It's very expensive.
Yes. So what is the maximum debt to income ratio that you should have if you're getting ready to buy a house?
So it's a great question. So the question's on debt to income ratio. If it helps people out there, if I can give like another analogy, I always give the analogy of like the high jump in the Olympics. I always say like in the Olympics, they set a bar in the high jump and the goal is to go over the bar. In my industry, we set a bar. It's called debt to income ratio, and the goal is to go under the bar. Generally speaking, well, let's talk about conventional loans. Generally speaking, for a conventional loan, your house payment generally should not exceed 28% of your gross monthly income. So gross monthly income, Sophie, it's the income before taxes come out. So if you say, Hesh, I make $36,000 a year, that's $3,000 a month before taxes. So your gross income is $3,000. If I take 28% of $3,000, which mathematically is, my goodness, it's about $900, give or take a little bit. You don't want your house payment to go over that dollar figure. Mm-hmm. So that's a level for debt to income ratio. For an FHA loan, the house payment generally should not exceed 31%. Mm-hmm. For a VA loan, they don't really have one for the house. Generally, you want to keep it around 30 to 40%. For USDA, it's 29%. So generally 30% for a house. For your total debt, generally, conventional loans are 36%. That's the traditional conventional for the total debt. That means all of your existing payments plus your new house payment generally should not exceed 36. FHA, it's 43. VA, generally, it's 41. USDA is 41. So you'll see they're in the high 30s, low 40s. Now, you could stretch those up, but generally, you want to stay within those ranges. When you start pushing the debt ratio higher, I hope your score's higher. You have more money down. You've got to mitigate that risk of the higher debt ratio then.
Got it. So I know you said monitor your credit on Sundays, take 30 minutes. What does that look like?
That's an awesome question. Credit monitoring, it's literally just, it's monitoring. It's when you send, like take me for example. So I'm signed up with MyFICO, myfico.com. So I love that website. It's the website of the Fair Isaac Corporation. They invented it. So I'm going to the people who made the site. And it made the site, they made the program, and that's who my industry uses today. Besides, now the tricky thing is they will give you credit scores also. I'd love to say that like those are right 9 times out of 10, but they're not always right either. But the point is, I'm not worried about what the score is. I'm worried about what's on the credit. So, for example, when you're monitoring your credit, especially if you have late payments, you want to pay attention. Did any lates come up? How are your credit card balances? You want to keep track of that. If you are paying off debt, is it updating that it's paid off and the balance is zero? So these are the things you want to pay attention to when you're monitoring it. And the monitoring, for someone who's not trying to repair their credit, you just sign up for the monitoring service and it'll ping you every time something happens. Your credit was checked, a collection hit you. You know, I had to go to, I stopped in the emergency room of the hospital. I had kidney stones. My goodness, just last year.
No fun.
Oh, those were not fun. I can tell you those were not fun. So I had to stop into the hospital. So I was calling the hospital saying like, hey, how much is the bill? What is the bill? Like, and I have insurance, but I know from pulling people's credit and following it so much that like, I've seen so many people with like medical collections on them and they're like, Hesh, I've got health insurance. It should have been covered. And I'm like, health insurance doesn't cover everything. You know, and you want to pay attention at the end of the day. If health insurance doesn't cover it, if you don't pay it, it's going to end up on your credit. So you never know, a medical collection might hit you. So if you're not trying to fix your credit, a monitoring service, which typically costs $30 to $50 a month, it'll ping you when it hits you. If you're trying to fix your credit, as you pay off debts and things like that, you want to make sure that that's being updated correctly. So the monitoring is, let me check my credit. And when a consumer checks their credit, it has no effect on their score.
Oh, I did not know that.
I can go to my Fico right now today and pull my credit. It'll have no effect on my score. It's not a hard inquiry.
Got it.
When I pull it, I'm like Jack the Ripper.
Right.
It's like bam. So every time your credit gets pulled, it's supposed to affect it adversely. 2 to 5 points is what the Fair Isaac Corporation says. So it's not a dramatic hit, and those are hard pulls. The soft pulls are when consumers do it for themselves, and it has no effect on the score.
Good to know. Okay, so, there's a lot of talk in the news about these rising interest rates. They are skyrocketing, apparently, and people are afraid that they're not going to be able to afford a house. So can you talk through the real impact of what rising interest rates really mean on a month-to-month basis on your mortgage payment, let's say on a $200,000 house?
So on like a $200,000 home, for example, the difference in mortgage payment on even 1% of interest, you're talking about like $100. You start going up into the 300s, $150, $200 difference per month. So let's just say it's around $100 per month for even a 1% interest rate change. It doesn't, with what's happening now in the market, with where inflation is, where it's projected to go, mortgage rates have absolutely gone higher. Higher is a relative term. Instead of being at 2.7, they're at 3.5 and even 3.7. How high is 3.7? I'm not sure. Now, they're still going to climb more. The Federal Reserve most recently has said that they're going to raise them 4 times in 2022. So at the end of the day, they're going to go even higher more than likely. Higher is relative. You're not talking going up 3, 4, 5 percentage points. You're talking about 1 percentage point. That difference is generally $100 per month on a monthly payment. What I tell people a lot of times is that you want to create a budget. Buying a home is such a big investment, Sophie, that you've got to budget yourself out, and you should be budgeting yourself out. So if you see that your payment's going to be $100 more this year than it would have been had you purchased or whatever it is, you want to see what are other places you can cut and save and do things at. And at the end of the day, it's just about budgeting. And it's affordable. It always has been affordable. I've been doing this now since 1999. And rates at that time were in the 7s, 8s, and 9s. And now we're going to go into the 3s and 4s and maybe 5s. So these rates are half of what they were. So it doesn't have as dramatic of an effect as we think. But every dollar does count.
Right.
So every dollar counts. We want them lower, but if you budget yourself and prepare for it and you know what's coming, home ownership. I actually told this to somebody the other day. They call it buyer fatigue. You would know this better than anybody.
Oh, yes.
Is the buyers who are going out there and placing multiple offers on houses, and they're going to their 4th, 5th, and 6th. I had one buyer, he got his offer taken on his 16th offer. Now, how in the world, he's not like, tranquilized or something like that, for that type of emotional roller coaster is beyond me. But he survived 15 other offers that were not accepted, and his 16th was accepted. So a term that's been thrown around out there is buyer fatigue. It's my emotions keep going up and down and up and down. And I told this to a first-time home buyer I was talking to just the other day, actually. I said that in the end, nothing compares to home ownership. It just doesn't. It just doesn't. I mean, nothing compares to owning your own home and being able to do things you want to do. And at the very end of the day, it's the best thing there is. So you want to stay strong. You want to budget, create a budget, follow your income, follow your expenses, and you'll ultimately see that nothing compares to home ownership. It's the best thing in the world.
I agree. And, I'm also an investor. I'm a landlord. And I know that rents are going up faster than the interest rates are. So if you're concerned about, your mortgage payment going up if you buy a house in the fall and, the interest rate's going to go up 0.5%, a full percent, your rent is going to go up this year, probably equally to what that mortgage payment is. Absolutely.
The average rent in the United States in 2008 was like $700 a month. The average rent in 2021 was $1,100 per month. So rents are almost double what they were. They're absolutely going up. It's just a fact. Rents are higher. We're starting to get to a point now where mortgage payments are very comparable to rent, very comparable. So it's way more in line because, again, 10 years ago, when rent was $700, you're buying a house for $200,000. you're looking at a payment still 12, 13, 1400. So it's dramatic, it's
Right.
much higher. Today it's way more in line. So rents are a lot higher. And again, the problem with renting to an extent, I always say, now owning's not always good, renting's not always bad necessarily. You've got to do it when it's the right time in your life. But at the very end of the day, when you when you rent, you're dependent upon the landlord.
Right.
Landlord, this is a great time to sell. Landlord says, I'm cashing out on everything. You got to go. And now you got to find somewhere else. And then you have a dog, you have a pet. People with pets, they know the renting situation better than anybody. And as that rent gets squeezed, they are really struggling to find a place. Again, this is why another reason why home ownership is so good. The NAR, the National Association of Realtors, says it all the time that just in the end, home ownership, it provides stability for families, stronger communities, consistency. It's nothing compares to it. So you don't want to be dependent upon your landlord. I know you're an investor, but
yes, I am.
But
yes, I agree with you though. I
Yeah.
think that anybody who can and is in a position and a time in their life to own a home, I think is definitely, and you build wealth and assets in the process.
Nothing compares to it. Just nothing compares. When you start going into the tax implications, a $1,200 mortgage payment, when you do the tax deduction, is not really $1,200. Renting $1,200, it's $1,200. And like you said, there's no appreciation, there's no gain in anything. Even over time, even in the second biggest crash in the history of our country, which was the Great Recession back in 2007, when home values dropped, if you owned a home back before then and your home value dropped and you own the same home today, you're up dramatically. So the truth is nothing compares to home ownership. It just doesn't. It's a big deal.
It is. All right, so let's talk about this. Yay, I have had an accepted offer, now what? So what are some important items that a buyer should stay on top of during the closing process?
See, this is an extremely good question. Again, the first thing I say to people, Sophie, when they get in the contract is this is when the fun begins, right?
Right.
So you've been driving them around for goodness how long, looking for houses, making multiple offers, and I've been in the shadows doing nothing. And now all of a sudden here I come with here comes Hesh now, the nice guy that was a few months I haven't heard from him. Well, now, as soon as you go into contract, the first things you got to remember is don't let anybody pull your credit. Don't buy anything. Don't do anything out of the normal of what you would normally do. You buying cars, charging up on your credit cards, going to the furniture store to start buying appliances to prepare. You don't want to do any of that. Now, I've had customers, of course, I'm sure you've had even more of them, call you and say, Home Depot's running a special on washer dryers only this weekend, 0% interest. I need to go get these things now. Can't do it. You do not want to do that. So the first thing you have to do is don't do anything out of the ordinary that you don't normally do. The next thing you have to do is give the loan officer every single thing they ask you. Don't ask questions. And what I tell people especially is to get a folder and everything the loan officer asks for, put it in the folder. And when the loan officer comes back and asks for it 3 more times, because it's going to happen, it's a lot of paperwork. Yes. I'm guilty as a loan officer of asking for the same thing 5 times. I get it. But you know what? Save everything you send so that when you get asked for the 5th time, it's driving you absolutely nuts. If it's sitting in a folder, it won't drive you too nuts because you were prepared for it and you were ready for it. You could send that over. So send everything you need to, send everything you get asked for, save copies of it. You'll be asked again probably. Don't do anything out of the ordinary from what you normally do.
And then also there are times during the closing process where a buyer is asked for additional paperwork. If they've already been pre-approved, why do they need to give additional paperwork?
It's an excellent question. So, and people ask that question, Sophie, all the time to me. When you are pre-approved, that is a general review of your pay stubs, your W-2s, your bank statements, and that information. You have to remember that there's a lot of other verifications that we do. We verify employment, for example. If your overtime has been going down consistently, your pay stub is not going to show me that. But the verification of employment from the employer will, because they itemize out your income. So suddenly I'm coming into information that we simply did not have before. On a pre-approval, we do not verify employment. Your bank statements actually update and cycle. So if I pre-approved you a month ago, your bank statement today is different than what you gave me a month ago. The deposits into today's bank account are different. A lot of people get money gifted to them. So we have to verify the donor's bank accounts and where that money came from. So the reason we have to go through a lot more paperwork is because we then do a very in-depth look at everything, not counting the fact that we monitor credit. If somebody else pulled your credit, we're going to ask questions there. So the loan process is dramatically much more in depth than the pre-approval is.
So in real estate, we get under contract and we all wait for that clear to close a few days before closing. Is it okay once we get that clear to close to go out and buy the furniture, to buy the appliances for the new house, to change jobs, to buy a car?
So I'm actually doing a topic I think called clear to close fact or fiction.
There you go.
So until you've signed the paperwork and you've been handed the keys by your agent, I should say that one. Until your agent has handed you the keys, which the agents, you all are kind of crazy. You don't hand keys until that thing's filed, recorded, done on title. And I'm sitting there saying, Sophie, they're good. Just let them have the keys. I'm not giving the keys for nothing, okay? Until the keys are in your hand and you're on title, it ain't over. So the truth is, don't do anything different until the keys are sitting in your hands. I'll give you an example. Clear to close. A lot of title companies will say, Hesh, we need the clear to close to set up the closing, okay? And it's Thursday. So it's Thursday, and they're signing Friday. And the title company says, we can't set up the closing until the lender says clear to close. So a lot of lenders will say, it's clear to close on Thursday. It's good. The truth is that if the customer quits their job on Friday, they'll take that loan straight off the table. So the question becomes, if the lender issued a clear to close on a Thursday, why would they decline the loan on a Friday if the customer quits their job? Simple. It really wasn't clear to close. Closing is filing. Filing is done. We're not letting that thing file until we've checked everything. We do re-verify employment a lot of times on the day of the closing. So when you get the clear to close, don't jump for joy. You're 99.9% of the way there. You're close. You're as close as you're going to be without having the house, but still not over.
Okay, good to know. So last question about this closing process. I know that when a buyer gets pre-approved, they have to show you where the down payment funds are located. Can they change where they get their down payment?
Great question. I guess I have two answers for that. So can they change where they get their down payment from, where it comes from? So we started the process, they signed the loan application, and all of a sudden 10 days before closing, they say, Hesh, my car broke down. I need to spend all the money on my bank account. I have no money. My mom's going to gift it to me. They can do that all day long. No problem. So they could change the source of where that money is coming from. Yes. Now we have to get mom's bank statements, get a gift letter, and go through a process. But yes, they can do that. Now, if it's, I verified it was in their Bank of America bank account ending in 1234, and that's where the funds are at. When they come to closing, they cannot send me the money from their Wells Fargo bank account. It's got to come from the bank account that's been verified. So you have to pay attention that we get very particular on where that money comes from. And all that has to do with, the big thing with the money, with verifying funds, we want to make sure that the seller's not giving them money. And we want to make sure they're not taking out loans, which would have payments associated to them, which thereby affect adversely the debt to income ratio. I've had people say it's like anti-money laundering and this and that and the other. And that sure sounds like a lot more interesting. Yeah. But we want to make sure the seller's not giving you money. We want to make sure you're not taking out loans.
Got it.
Pretty cut and dry. But we're kind of crazy at verifying.
Got it. So if I were to change it, make sure I tell you a few days ahead of time so you can verify.
1,000%. I always tell people, give me 10 days advance notice. 10 days. When I get within 10 days of that closing, it better all be in. Because the problem is with verifying it, people are working jobs 9 to 5. Right. I need them to print out their transaction history from online banking, and they can't do it during the day, and they don't know how to do it in the evening, and they print it out wrong, and the next thing you know, you're coming near the closing, it just turns into a mess. So you want to try to finish everything up within about 10 days of closing if you can.
Okay, we'll keep that in mind.
Absolutely.
All right, so let's talk about appraisals.
Yep.
What is an appraisal?
So an appraisal is nothing more than an opinion of value. The opinion is that of the individual who goes out there, also known as the appraiser. So the appraisal basically tells us that how much somebody is paying for the home is justified based on sales in the area. I hate saying that the appraisal tells you the exact value of the house. I mean, it does, but I mean, my goodness, it's the value, it's based on that day at that moment in time, based on that individual who went out there. I actually have examples, Sophie, of, I had this happen last year actually, where I had 3 appraisals on the same house. I was the third lender that came into the picture. The first appraisal was done, it was an FHA appraisal. The first appraisal was done within a 90-day window of an investor buying it, which invalidated that appraisal. But that was one appraisal. The second appraisal was the new lender that came in. That was the second one. And then I came in for the buyer. So the buyer was declined at 2 other places. And then they came to me. I was the third person in line. So we ended up closing the loan. But I had to get a new appraisal because it was a flip. And FHA has guidelines on how many appraisals are needed if the house sells for more than 100% of the previous sales price. So I had to get an appraisal. So we had 3 appraisals done within 30 days. They all had different values, all different numbers. Mm-hmm. So people imagine the appraisal of the house like this is the value of the house. It's not like a can of soup at Walmart where if you go to 10 different Walmarts, it's all the same price. Mm-hmm. The appraisal, to answer your question and take 25 minutes to answer it, the definition is it's an opinion of value of the individual who goes out there, but it's not, it's take it with a grain of salt to an extent. It tells us that the purchase price is justified based on the sales in the area.
Got it. And who pays for the appraisal?
The borrower pays for the appraisal. So the borrower is charged for the appraisal. Those appraisal fees today are in the fours and fives, $400, $500, $450, $550. They're in that range generally.
And why is it important to the lender to have an appraisal?
So it's a great question. Ultimately, the lender is loaning money on a house, which is being used as collateral. And if the borrower defaults, the lender wants to know, can we get our money back out of this house? So the appraisal gives us the best measurement for, are we going to get our money back on the house? So,
and do you think it benefits the buyers? Do
I think the appraisal benefits the buyers? The appraisal somewhat benefits the buyers, even though nobody knows how to read one to an extent. It benefits them definitely. I mean, it benefits them. That's an interesting question. I've never been asked that question. So I'm kind of like stumbling through it a little bit. Like I'm actually, when I really think deeply on it, it benefits the buyers. I love home inspections, but they're not required for mortgages.
Right.
Like, but we have a disclosure that we give in my industry. It says, for your protection, get a home inspection. Appraisals, they definitely benefit the borrower, but don't put too much stock on them. I think that's something, Sophie, that, and you would know this better because you list homes for sale also, that I think people imagine the appraisal is an inspection.
Right.
And I know with FHA specifically, it's actually in the HUD handbook, it says an appraisal is not a home inspection. It has it in all caps. Like that's the emphasis they want to put on it. An appraisal is not a home inspection. FHA appraisals are not inspections. They're in and out of that house inside of 20 minutes.
Right.
Home inspections are home inspections. They're not required, but highly recommended. But they do benefit the borrower. Yes.
I always tell my clients that it protects them from, significantly overpaying on a house.
There's no question. You're going to see that based on the comparables in the area. There's no question about that. You're going to see the sales comparables that are used. It gives you the addresses, the square footage, the measurements, the sale dates, the prices, everything. It gives you listings. So in that, there's no question. I agree with you totally on what you said.
So what happens if a house doesn't appraise?
It's a great question. So ultimately, the value of the home from the lender's perspective is the lesser of the purchase price or the appraised value. So whichever one is the lower number, that's what the loan works off of. The example I always give is a VA loan. Because VA loans are 100% finance. It's no money down. So it's an easy visual to give to people. So let's pretend a veteran is buying a home for $100,000. And if the purchase price is $100,000, but the house appraises at $90,000. If it appraises at $90,000, I will give them $90,000. I won't give them $100,000. To me, the value is the lower of the two. So that's just a standard guideline for all types of loans. When houses come in for lower value, the lender will only loan off of the lower number. In those cases, the seller has to come down, the buyer has to cover the difference, or they both have to meet in the middle somewhere. So those are, I guess the fourth choice is all bets are off and the deal's done and move on. But those are the four choices. When an appraisal comes in lower, the seller can come down, the buyer can cover the shortage, they can meet, come up with some agreement between the two of them, or the deal's off.
Thank you. And is there a big difference between conventional and FHA appraisals?
This is my most favorite question and my most hated perception. People believe that there's a dramatic difference between conventional appraisals and FHA appraisals. There used to be before 2007. Then the mortgage crisis happened. FHA overhauled all of their appraisal guidelines. They made a couple changes since then. The truth is, no, there's not. There's really not.
Okay. And are VA appraisals tougher on a home than other appraisals?
It's so funny that you asked the question about VA appraisals. There's not a dramatic or a very big difference. VA just overhauled their appraisal now. It's almost identical now to conventional. So as of 2022, VA appraisals are almost identical to conventional. And I mean, it's kind of crazy. It is almost identical now. So there's not a difference. It's up to the individual appraiser. When it comes to appraisals, the biggest thing people want to keep in mind is safety, soundness, security. Those are the three S's: safety, soundness, security. So when you talk about safety, if there's loose wires in the basement hanging from the ceiling or hanging out of the panel box, that's a safety issue. That has nothing to do with the FHA, with VA, or with conventional. That's a safety issue. That'll get called out all day long. Federal Pacific boxes.
Oh, yes.
I've had people say, Hesh, Federal Pacific is a violation for FHA. No, it's not. It's not at all. It used to be. They got rid of that. VA, Federal Pacific's not illegal. There's nothing wrong with it. Now, if the appraiser looks at the Federal Pacific box and says, that thing's going to burn this house to the ground, they'll call that out. It's not an FHA or a VA thing. So there's not really these big differences at all that these people have the perception. I can show you appraisals of missing handrails on FHA that they don't call it out, but it's missing on conventional, it's called out. So I think that's a big problem in the market, because that's why people lean towards conventional financing. They think the appraisals are more difficult. They're not. It's up to the individual appraiser who goes out there, and it's their call. Safety, soundness, security. Is it a safety issue? Does it function? And does it provide security for the house? That's really what they look at. Smoke detectors. Okay. Smoke detectors are not required, but if the appraiser says it's required, it's going to be required. They call it out, it's going to be a problem for any type of loan.
Got it. Thank you.
Yeah, those are great questions.
All right. Last one, understanding closing costs. So what are charges in addition to the down payment that a buyer can expect to have to pay?
So ultimately what I tell people is there's three pieces of money that people need to have when they're buying a home. There's three, and they can write these down. Number one is the down payment. The down payment is FHA's 3.5. Conventional, you can go 3%, 5%, 10%. So that's the down payment, number one. Number two are closing costs. Closing costs are lender fees, title fees, surveys, recording fee of the county. Those are closing costs. Those are the fees required to close the loan. Loan doesn't close, you don't buy the house, you're not charged any of that. Lastly, there are what are called prepaid items. That's your home inspection, that's your home appraisal, and you typically have to prepay for 1 year of homeowner's insurance. I break those down into down payment, closing cost, prepaid items. So it's three separate sets of fees that you want to pay attention to. I always tell people, Sophie, that I always tell people, put a star by the closing cost. The seller, you as the agent, of course, and you do a great job of this, can negotiate with the seller to cover the buyer's closing cost. Thereby, it only leaves the buyer with the down payment and the prepaid items. So those could be minimized in that way. Even some of the prepaid items could be put onto a credit card. Now, when people hear me say charged on a credit card, a lot of people are, oh my God, that's terrible. Not necessarily. If you're managing your debt and you're budgeted, it's not bad to charge the home inspection or the home appraisal or the homeowner's insurance on your credit card. You can get it down to literally the buyer only needs to come up with the down payment. Seller covers the closing cost. The prepaid items could be charged. There's ways to minimize those numbers. But that's the total amount of money people need when they're looking at that.
So I know when I write contracts for my clients, I will say that the seller will pay up to a certain amount of money of the buyer's closing cost prepays points. what is the maximum percentage that a seller can pay towards a buyer's closing costs?
So ultimately, for example, for FHA, a seller's allowed to pay up to 6% of the purchase price towards the closing cost. For VA, a seller's allowed to pay 4% is generally the number looked at. If it's more than 4%, it just depends on the market you're in if it's allowable. And the truth is it's more than likely allowable, but 4% is a guide for VA. For conventional loans, if you put less than 10% down, the buyer does, the seller can only pay up to 3% of the purchase price towards closing cost. If the buyer puts more than 10% down, then the seller can pay up to 6% towards the buyer's closing cost.
Okay, I did not know that difference.
And USDA, the seller can cover up to 6%. USDA allows you to actually roll the fees into the loan. It's the only loan type that you can actually roll the closing cost back on top of the loan. The house has to appraise for more accordingly, but that's the only one that does that.
So for a $100,000 house, you've got 6% closing costs. The house would have to appraise for $106,000.
Yes, absolutely, yes.
Okay, and how many of these closing fees are non-refundable?
That's a great question. How many of the closing fees are non-refundable? The only fees that are non-refundable are the home inspection and the home appraisal.
Oh, good. Okay. And then you said that they are not charged a closing cost, the other ones, if the loan doesn't close.
The loan does not close. You are not charged lender fees, title fees, recording of the county, survey. You're not charged any of that stuff.
Okay. Well, thank you.
Well, I appreciate it, Sophie. And
Yes.
thanks so much for the opportunity. And
Thank you. This has been very educational to me, and I'm sure to everybody who's watching this.
well, I appreciate it sincerely. And thank you. We'll be talking more definitely.
Will do. Thank you.
Awesome.